name is Liz Notling, and I'm the Director of Operations with Anew Advisors. Today, our webinar will be focused on the Q3 market update. Just get this going right here. Nick Schneider and Glenn Colwell will be presenting, and just a few housekeeping things before we get started. During the presentation, you may ask questions at any time. There will be a specific spot at the end of the webinar where we will have a Q&A as well for any questions that you may have afterwards. Just our standard disclosures in here. Today, we'll be talking about who is Anew, our monthly education events, quarterly market update, that's why you're here, and of course, next steps. Just a little bit about Anew. This is our mission. Our mission is a value-focused organization. We have real financial conversations, and we provide real results. Our vision is to be the investment firm of choice for our future, or for our community. And of course, we have our values here. A little bit about our team. We have Glenn and Nick, who will be on today, and of course myself, and then our business development officers, Mike, Anthony, and Sean. A little bit of our history. One of the biggest things that we are proud of is we have combined over 60 years of financial experience in the financial industry and over 60 years experience in the first responder industry. And just to touch on our financial education calendar, we do monthly webinars. We still have November and December of this year, and then we'll be coming out with our 2024 calendar shortly. So I'll go ahead and turn it over to Glenn.
Thanks, Liz. Good morning, everyone, or I should say good afternoon for those that are on the East Coast. We like to start this off with kind of like what's going on in the headline news and the latest, what I call Armageddon, because basically at the end of the day, markets run on fear and greed, and so is the news cycle. So this is a static slide we tend to use, and what we do is we just kind of update the latest fear mongering, if you will. Not only do we still have Ukraine in the news, now we have Israel in the news, unfortunately. There's still some question in regards to another Fed rate hike. We think we might get one more, maybe even as early as sometime this year in November or December. You're still hearing this inflation ramp up, although we see it very concentrated. One of the things I think that everyone is feeling is in the grocery store, is the inflation aspect to it. And don't expect that to go away anytime soon. We'll talk a little bit about that. Unemployment, I have to tell you that as we watch unemployment numbers and we watch inflation numbers, unemployment is actually back at pre-pandemic levels as far as employment. So anyone that wants a job can have a job, can work. But from an employment standpoint in this country of the U.S., it is being very productive for those that want to work and that need to work. So the numbers we're starting to see here looks very good for that. Kind of the caveat out there to all this with the high interest rates is you're starting to see loans, whether it's credit cards, car loans, student loans, bank loans, they're going to get ready to start to reset at higher interest rates. And that's going to put a lot of impact on consumers, not so much businesses. If you've been watching the debt refinance cycle over the last 4 or 5 years, most institutions did one heck of a job at refinancing their debt when the rates were like next to zero, right? So you look at companies when they have a huge balance sheet and a huge debt line, most of that debt is at very, very low interest rates. And that makes it very good and healthy for the companies. But for the consumers that can't really control that level of interest rate or haven't taken the time to refinance on some of the variable loans, that's going to start to impact them greatly. It's also a cause of the home market in this country. You just have a plethora of people that did actually refinance their home at lower interest rates that aren't willing to give that rate up, and they're not moving. So that's causing some compact in the housing market that we'll talk about in a moment. All that said, that seems to be the latest fear mongering, and I say that with not to disrespect it, but you have to take everything with a grain of salt, especially with news. For every bad thing that they're saying out there, there are some good things going on in the market that we'll touch on, and feel free to ask questions in the chat box like Liz mentioned. And here is some of the good news right out of the box. So we look at GDP, right, gross domestic product. If you look at the box inside the chart, that's measuring quarter by quarter, starting in third quarter of 2022. You get quarter over quarter and then year over year. SAR, seasonally adjusted rates. There's always revisions to these. Like you get the economists and the managers, money managers come out and they make this prediction or they report on a number. And then if you just kind of pause for a moment and you wait a month or two, they get revised. And so that's what we try to do. We try not to make any hasty decisions upon any of these numbers that come out. But the trend line, watch the trend line, everyone. The trend line is up. Gross domestic product is doing well. It's on the way back up. And we're back above that 2% number, which is a very, very good thing for our size economy. And what's most important on the right-hand side is you see the consumer makes up at least 2/3 of the GDP. U.S. consumers, for those of you who are on this or that are going to listen to recording, we always say this, U.S. consumers consume goods and services, even during hard times. We are a country and a demographic that's built to consume and spend money. You need to get in front of that consumption rate and that consumption pattern. So I'll leave it at that, but GDP is trending up. This is probably, in my opinion, if not the most important chart, this is going to be one of two important charts. I think Nick's going to touch on the other one that looks just like this. This looks like the S&P 500, right? S&P 500, 500 largest companies in the U.S. This puts everything into perspective. The red dot in any given year is where the market sat at an extreme low intra-year. Doesn't mean it ended up there, and most times it does not. But it's perspective. When 2008 hit, the world was falling apart, right? So you're down 49% intra-year. Well, yes, you were down 38% at the end of the year, and that sucked. That didn't feel good, but you weren't at the lows. If you look last year, at one point, the market was down 25% and ended down 19%. This year, we were down as far as 8%, actually closed the business on Friday, you're up over 13%. So look at the market ebbs and flows. We know that you can't sit there and focus on just the negative aspect. You have to look at the way we construct portfolios. You have to look at the cash flow of the portfolios. You have to look at the health of the companies. Just know that the news is going to report the red dot and they're going to try to sell that. So just keep that in perspective, please. And if you have questions, you know how to get a hold of us, but call, email, text, send smoke signals, however you want to do that to get a hold of us. We're happy to help.
Yeah, and let's talk a little bit about why that S&P 500 has still been up like it has. I'm going to kind of draw everyone's attention here to this first chart on the top right-hand corner. This is the weight of the top 10 stocks of the S&P 500. So right now, the top 10 companies by market cap make up 32% of the S&P 500. And some of these are your big companies. They're your Facebook, Amazon, Google, Microsoft, NVIDIA, Apple. They're big tech companies, they're growth companies, and they've really propelled the S&P 500 forward for the vast majority of the year. And some of the other sectors came back until about the last month or so, but it's really been driven by about 10 companies. So if you haven't owned those, if you own a portfolio that's constructed with individual securities, if you're not overweight those, there's no chance you're keeping up with the S&P 500 because of the extreme growth of those 10 and what they're weighted even in the S&P 500. And that shows up too, even in the earnings, right? The earnings for those couple of companies over this year have far surpassed any of the other companies, at least on average, for the S&P 500, to the tune of contributing 20% or 22%, excuse me, of all earnings for the S&P 500 as well, as come from essentially 10 companies. Next slide, Liz. And this is really for the last quarter. There hasn't really been a lot of places to hide. So what you're going to see here, I'm going to draw everyone's attention to this top gray bar. And if you look across what's happened over the last quarter, basically, if you weren't in energy, consumer services, you kind of felt it a little bit, right? I mean, that's where even this last quarter, we felt some of that drawback in tech, real estate, with interest rates being high, down 9.5%. So if you weren't in, again, those top 10 companies or held very specific energy companies, because even the largest energy company in the country was down over the last quarter. So even there, you had to own very specific energy companies, at least in the short term. So ultimately, not really a good place to hide over the last quarter when it came to returns. But if you look at year to date, most of these sectors are still doing well. Utilities have been hurt a little bit by interest rates. And then again, you're going to see that real estate is kind of taking, again, very interest rate sensitive sectors. And that's with raising rates what's happened. But overall, it's still been a pretty solid year to date.
Can I just point out I'm sorry, I can go back one. I just want to point out one thing. Again, perspective. If you look at that second to bottom gray row, since market peak of February 2020, you look at that, even since the market quote unquote peaked, there's only one sector that's down, and that's real estate. And again, you got to look at the real estate market. You have high prices, you have high interest rates, right? There's a whole bunch of variables going on there. But again, it's putting things into perspective over a little bit longer time frame, and not just focusing so much either on the quarter, intra-quarter, or what the news is telling you. If you kind of let this play out a little bit, and where GDP is going and consumption's going, you're starting to see where the tide is turning for these companies, and they're performing well. It doesn't always necessarily show up in the stock price on any given day.
And on that, when you start talking about sectors too, we want to talk about, what type of companies are they, right? The big ones we always see on the US side, it's always a value versus growth conversation. Your big growth companies that don't pay a dividend, your Apples, your Googles, companies like that are reinvesting to things like R&D, trying to grow, versus your value companies, which are more of your big blue chip dividend payer stocks. So one thing we look at is what's the spread between them essentially. So when you look at that big chart on the left, you're seeing the spread essentially between value and growth and what's considered cheap and expensive. So right now, you can see our line all the way on the right. Those value stocks are relatively cheap because growth has done so well this year. And this goes in cycles. There's going to be years where value does really well, and there's going to be years where growth does really well. But what we do know for these value companies now, even when they're relatively undervalued, you're still paying dividends. So whether you're collecting the income or reinvesting the income, it's still going to be an advantage to the portfolio, even when they are relatively cheap. And that's where, again, you look at these dividend yields long term. Value right now, dividend yields on average about 2.58%. PE ratios are still looking very good. We don't start to think that anything's overweighted until you start to get to the 24, 25 range. So even now, growth is still kind of in range of where it's not really in a danger. So right now we're not seeing anything until maybe early 2024 where this starts to balance out, but this is where we sit as of today. Slide, Liz. And interest rates, like Glenn mentioned, if you look at this chart, this is what interest rates have done. And then when you get to the right quarter of this chart, you start to see some estimates between what the market's going to do on the federal funds rate. So as you can see right now, sitting at 5.38%, there is a chance we think we could see that bump up. There could be 1 or 2 more rate hikes going into the end of this year or next year. It's really tough to tell. We're kind of the mindset where we might truly get 1 more before they start to bring them back down over the coming years. And we've talked about it before, especially going into an election cycle. It's hard to have interest rates as high as they are, but we think it's going to be their last push to drive inflation down further before they have to kick it back up. So we do expect them to bring interest rates back down next year, but we could see 1 more.
Yeah, and I would just mention in addition to this, I think you've heard us say this before, that high interest rates in a presidential election year is not good, so they will drop them next year. I think we're still of that mindset. I think what's changing from a consensus standpoint is they probably won't drop them as far as we thought they would. They're going to hold this out a little bit, and you're starting to first see this in that green line where you see the 3.9, right? You're starting to see a right turn there instead of continuing to go down. At some point, I don't think they drop them as much as they have in the past. I think it's kind of just ammunition for them to kind of pause and wait to see if they need to continue to hold it or maybe even increase it after they get through the presidential election.
Agreed. So what has that done to bonds? Interest rates or bonds are very interest rate sensitive. So when you start to see interest rates go up, bond values go down, because as you reissue new debt, you can get new debt paying at a higher interest rate. So just like we show that chart for the S&P 500, this one is showing it for the bond market. This is intra-year returns versus where the bond market has actually finished at the end of the year. As you can see, there have been big years for bonds, historically going back to the 80s and even some in the 90s. But over the last 10 years or so, it's been really a rough go for bonds, where a lot of these years you're not keeping pace with inflation. But just like stocks, every given year there is a down. But what's happened now is we haven't had a period like this where bonds have been down potentially in 3 consecutive years. And this is for the aggregate. So you're looking back, there will be down years in bonds, but it's never been a run like this. And 2022 was the worst year for bonds we've seen in 40 years. So as we start to look at that, there might be some opportunities with higher issuing bonds, knowing that rates could come back down next year. We are looking at potential opportunities in the bond space to get only yield, but potentially growth. So just something to look out for when you look at, the technicals of bonds and then the fundamentals of the companies issuing those bonds.
Yeah, I just want to make one comment on, sorry, can you go back one, Liz? This is perspective, right? So whether you're an institution that we're advising to, on a corporate level or a state level, municipality, or you're an individual, at some level, you either need income and or growth. And it's always been traditional that if you need income and safety, you go to cash and bonds. For those of you that are on the line or listen to the recording, you've heard me for years say you do not want to be in cash and bonds in a rising interest rate environment. And that's the result. You get low to negative returns and no consumption ability if you're using cash or bonds. We're just now at a point, as Nick mentioned, where if they are topped out at raising interest rates, it might be the time for us to allocate some portion of the portfolio to bonds to pick up yield and growth as an anchor in the portfolio. So you will see probably a memo from us either later this year or early next year if we're going to consider this. If you have any additional questions exactly on your portfolio construction, please reach out to us. And this is our investment philosophy. So where we can affect this and how we can affect this across clients' portfolios, either on an institutional or individual level, we believe in owning individual equities and not mutual funds where we can, right? And sometimes it's just not doable, especially if it's inside of some type of retirement plan as an active employee of an organization. We don't want to pay extra embedded fees in any type of product, especially a retail mutual fund. And then we want the companies that we're buying to pay a dividend. Cash flow is king, even in a high interest rate, high inflation market. If we know that we can get cash off of an investment and reuse that to reinvest back more into that particular entity that's strong, you will do very well over time. And the data shows it in that chart below. And then again, consumption demand in our country is number one. You won't go anywhere in the world and find demographics that we have within our own borders and the way we're trained to buy stuff. So we want baby boomers and millennials to be buying the companies of goods and services that we buy, and we want those companies to reward our shareholders in the form of cash payments. You line those two requirements up, and over periods of time, we do very, very well.
I'm just going to add too, this is the lens that we view investing through. So even if we're giving advice on holdings potentially in a 457, 401k, anything like that, this is at least the lens that we're trying to give that advice through. We can't always implement it perfectly, but we are going to do our best to meet our investment philosophy through what's available.
Open for questions. I believe there's a chat box that you can use, right, Liz?
Yep, the chat's open at any time.
Okay. And what we tend to see is most don't use a chat box. They send us an email or voicemail or text after. So please feel free to do that as well. For our first responder clients, whether you're law enforcement, fire service, these are our business director officers. For our private sector clients, please feel free to reach out to Nick or I. So we appreciate the time and the effort that you put into this and allocating your time to this. And again, we will see you next quarter with a quarterly market update, but we do have our education calendar that has our next month's Zoom that I think Liz will email out to everyone. Is that correct?
Yep, that's correct.
Perfect. Thank you, everyone.
Thanks, everybody.
Thank you. That concludes our webinar for today.